trajectory. Let's look at the last time when they started easing in September 2007. CPI, PPI were still on an upward trajectory. In fact, PPI increased that and peaked that year around 10%, and they were easing. Now they're actually still, the PPI is turning down hard, and they're still tightening. So where it happens, where it goes, I don't know. But the point is, once that unemployment starts ticking up, it's almost guaranteed the recession will be starting at some point soon. And then that's the rules of long and variable lags. Just the fact that we're still talking about it a year after the most aggressive central bank hike, coordinated central bank hikes ever, is the macro, and it's the long and variable lags that are just getting started. The banking crisis is a tree in that forest.
Mike McGlone is a senior commodity strategist at Bloomberg Intelligence. He recently expressed his opinion on the Federal Reserve and its policy of tightening and liquidation. According to McGlone, the Fed's tightening measures are resulting in a withdrawal of liquidity from markets. This has been a common trend in recent years as the central bank has continued to raise interest rates in order to help control inflation. The Federal Reserve's tightening policies have had mixed results so far. While these policies have helped reduce inflation, they have also caused market volatility overall. Mike McGlone believes that the Federal Reserve's current policy of tightening and liquidation will continue to cause disruption in financial markets. As we head out to listen to him, please hit the like button and subscribe to the channel.
You cannot not expect a credit contraction when money is leaving the banks at this pace. There's no way to avoid it. They can't lend it out. They can't hypothecate, whatever. They can't do fractional reserve lending when they don't have the reserves. And when the reserve assets, their duration matches are dropping. You know, they did not really, apparently, in our stress test, we did not measure the duration risk of the Fed raising rates at the highest pace, the greatest pace in history. So that to me is inevitable. The key thing is what solves that problem. What got us there? Fed raising rate hikes really fast. Cutting rates is what helps solve it, and they're still hiking rates. There's virtually no way banking fairs have society if you don't fix the problem. The problem with banks was risk asset duration mismatch because interest rates rose so fast. That's still rising, and there's still a bank run, so money's still leaving the bank. So there's a problem there. And in all bear markets, you have your most significant bounces. Good example is market dropped 50% in 1929. In 1930, it rallied 50%, and then the rest is history. That, I think, is happening in a mini case right now. We just had this decent bounce in the NASDAQ around 19-20%. Now, in the long term, I fully expect tech is going to outperform, but Silicon Valley Bank is very part of that. And I look at it as the Fed's stated goal is to reduce inflation, and what really helped pump inflation was rising risk assets. So what you're hearing and readings have to be very careful, sell-side research, and people have a vested interest in that working. And I look at it as this is similar to the peak in 2000, and then the peak again in 2007 and 8. And that one in 2000 took 14 years or so to really get above there. I think this is going to be similar. It's just normal. But the thing that's different is we have a significant bank run, and the Fed is still tightening. Oh, absolutely. Well, that's basically what we've had for 10, 20 years, particularly since the commodities and crude oil peaked in 2008. We've had significant disinflation, and that disinflation fact of rapidly advancing technology is going to accelerate. And I think what happened with the war is it triggered the whole world to accelerate the process of technology replacing things like fossil fuels and renewables. That's just accelerating. That's just normal. That was the normal pace before. I mean, I have an electric car I bought almost 10 years ago. I have electric bikes. I put solar panels on my house almost 10 years ago. That process has just got a lot more. Now there's nothing like, what's the best thing for all invention, necessity. So that necessity is kicking in. But right now, I think we have to go through that reset process, and the key bottom line in the macro is number 1, number 10 on the world scale. The Fed, on the 1 to 10 scale, is the Federal Reserve is still tightening. Liquidity is being pulled. If you're long liquid assets, you are fighting the Fed and the most central banks on the planet who are still following the Fed in tightening. Good question. I'm across that bridge when we get there. The way I see it. Well, I mean, the way I see it, it's got to start. The way I see the next scenario is If the stock market doesn't have that significant correction, then I have to reset the whole view. The bond market says it will. The yield curve says it will. And the Federal Reserve is looking for that so they can reduce that lagging measure of inflation, which is, and a forward measure is tilting towards deflation, natural gas. So I don't really know yet. I don't want to waste too many words. And right now I'm looking on the first bridge right now. And that is, to me, the next key thing to watch is, if I'm right, the S&P 500 should head towards 3,000. And if it doesn't, the problem is if it doesn't roll over, the Fed's going to keep tightening until it goes down, which is the stated goal at the moment. It used to be a lot more. I think energy equities have been some of the best investments the last few years, and that was one area I fully endorsed. And I always pointed out, if you're bullish energy, don't buy the underlying commodities that track the energy commodities, because you're most always better off buying the producers. Why? Because the producers can create more with less on a daily basis, and by doing so, they pressure the price. So it's just such a small factor now compared to tech. But the key thing is, I look from energy is, what's the indications? Energy is a great indication of the organic economy, like copper, demand pull for things that are related to the economic case. And the fact that crude oil is down about 19-20% on an annual basis, and copper's down about 14% on an annual basis, and gold's up, that's a bearish indication for the stock market. And so what does that mean? Okay, forward-looking measures are showing deflation. The Fed should be easing. They're still tightening. That's the lose-lose for risk assets in the macro. And from an energy standpoint, pointing out deflation, but the fact is the Fed's still focused on inflation and tightening. That's bad for equities. Well, it's a good indication of the strength of the U.S. Like I said, you look at 10 years ago, the U.S. is transmogrified, a great word I learned from reading Calvin Hobbes when I was a kid, into the world's largest energy producer, net exporter. Okay, so when there's petrodollars, it's because we're the largest importer, needed protection. Okay, is that bad for economy or country? Largest net exporter of agriculture. We can feed ourselves. We got energy, and it's just adopting the technology, and it's a system of discourse. So if you want to trade your anything, a commodity you want between countries in a currency that typically has a history of no background, no discourse, no free flow of capital, no deep treasury and capital markets like the U.S., I'm like, good luck with that. Brazil is it's been a melting currency, except this year it's doing great. But most of those currencies historically do not do well versus the dollar over time. And I'm like, yeah, well, good luck. But if you look at the newest rapidly advancing technology in the planet, cryptos, they adopt the dollar as a base layer without trying. The most widely traded cryptos are crypto dollars, tokens that track the dollar, Ethereum type tokens, whatever other protocol. That's organically happened. Even though the U.S. pushing back on it, the world said, no, we want dollars. We don't want the yuan or the euro or the ruble. So I like that's just indication of the U.S. moving on, and it's don't have to buy crude anymore. And the key question I like to ask when you're purchasing or selling these other, what you do when you transact in other countries' currency, do you put it into their treasury bonds? And I like to say, well, good luck with that one. There's no deeper market in the world than the U.S. Treasury market. Well, it's minimal. You can buy GLD and most of these ETFs at fraction basis points. And nowadays, you don't have to buy the equities. You don't have to put it in it. It's just so easy. You push a button. You can even buy it through a crypto token. So I view this as complete complements. The key thing is there's limited upside. You buy a bond, you get the yield, and it goes to par as much. That's as much what you get. With gold, you have the X's of return. You can easily. I think gold's going to do what it did last time. It did a 2X in a couple of years. Some of the miners will do that, but you have to be selective which ones you pick. But they're good complements. It's also what happens when if you buy a T-bill, what happens after it expires? You buy it around 4.5, expires, and what if rates a year or two from now are running percent? I think they might be or less. It's that enduring trend. And I like to point out it's the best performing major commodity on a 1-year basis. And it's best one this year, certainly compared to crude oil. And the key question you have to ask yourself is what stops that? I think it's early days, because typically gold you want to stop being long gold after it gets expensive, after we've had a pretty severe recession, the Fed's eased, and it's time to buy equities. Okay, well, looks like we're not even there yet. We're not even there yet. We got some markets for pricing for that already. The Fed funds futures are already pricing for lower rates. I'll type on the screen right now we're looking at by the end of this year, rates are currently around 5%, looking for 4.3% in Fed fund futures. So it's already priced, and it's not in other markets, but other markets will follow. And if you know what happens if the U.S. recession, it goes in recession, it's the man pool economy in the country, on the planet. I mean, Europe's going to go into the rest of the world. You know, the U.S. sneezes, the rest of the world gets to catch a bad cold. That's just going to happen, typically that way. So, and we're leading that way. And then we also have this presidential election coming up, so that's going to be a major shift. But I don't see basically you can talk about current trajectories. And current trajectories are what stops it. And that's the key thing I like to say is typically for me to say, okay, it's time gold rally's over, and you'd have to have the big well past that period of Fed ease and the stock bear market. Seems like we haven't even started yet.